Hello, clients and friends of MBP Sterling Partners. It's Jamie, and I'm back to give you another recap of where we are in the markets year to date. This was supposed to be a Q3 recap, but we're running a little late, so hopefully we will be able to include a little bit more of the action that's happened as we enter Q4. Well, the themes so far for the markets have largely been around tariffs. We all remember back to that in March and April. Rate cuts as the US Federal Reserve has resumed their rate cutting cycle and Canada has continued theirs. AI has been the story for the equity markets the entire way along. And then, of course, back to our diversification theme, or should we call it diversification? So far this year, returns have been pretty good in the equity markets. We noticed that foreign equity markets in particular have done remarkably well. This is still in the catch-up phase as the US has dominated for many, many years in the equity space. But foreign markets, especially those in Europe, are making a big comeback this year. The US, which struggled through its tariff implementation in March and April, has roared right back, and it's still performing very well for the year, but hasn't quite caught up to the rest of the world's markets. The bond markets, we should note, have been very boring and very average. That's exactly what we want from bonds, so we're not going to complain. Bonds are pointing into the end of the year with not a lot of disruption and modestly positive returns, and very little correlation to equity markets, which is how we like them. Notably in Canada, gold has been the standout sector, material sector, and at large, but particularly the gold subsector of materials has performed extraordinarily well. And everybody knows the story of how gold has progressed through the year, particularly starting in Q3 when things really started to take off. The US sectors are largely positive across the board. So we do speak about diversification and concentration, but recall that in the new world, a lot of the big names that we're used to hearing about, those magnificent 7, 8, or 10, depending on how many we want to talk about, are actually across a few sectors now. They are not all concentrated to the technology sector. So there are positive returns across many sectors, with consumer staples being the only losing sector in Q3 in the US. Notably, we also see volatility just continuing to drop lower. Volatility tends to come in spikes and then fade away over time. And right now, we've been in an extended period of watching that volatility fade to the point where we are starting to get a little bit concerned that it's going to rear its ugly head again. But we will get into that in the Outlook video. Let's revisit our old theme about cap weighting versus equal weighting. You might recall that there's a huge concentration in the US markets in particular. In Canada, we are not seeing it all, and there's very little difference between cap and equal weighted, as you can see on the bottom chart here. But in the US, after equal weight made a little bit of a comeback through the market decline in March and April, it's been all cap since then. And we're seeing once again cap weighted. So the mega cap companies are taking off and stealing a lot of the returns, or we should say providing the majority of the returns to the cap weighted index. So that spread between the two is growing and has grown throughout the back half of this year. Let's look at loonies and bonds now. The Canadian dollar continues lower. So we did have a brief moment in Q1 and 2 where the Canadian dollar was looking strong. That was actually the US dollar looking weak and not the Canadian dollar looking strong. As you can see, the green and orange lines on the left here are Canadian dollars versus euros and yen. You can see a pretty steady decline throughout the year. So that event where we saw our dollar getting stronger was really only against that purple line, which is the US dollar. It weakened through Q1 and 2, but it has flattened out and the Canadian dollar has resumed its weakness. So bond spreads are not helping that case. We look to the spread between US and Canadian 2-year bonds as an indicator of where the Canadian dollar might go. We also look to energy resources as a big exporter of energy. Neither of those is helping our cause, and we've seen a pretty weak Canadian dollar across the board. So you'll see in Q3, green across the screens for pounds, euros, Aussie dollars, Chinese renminbi, Swiss francs, doesn't matter how you measure it. Yen was the only one that was remotely flat against the Canadian dollar. What about the bond side? Well, bond yields have started to turn lower after a very mixed year. They're still range bound, but they're pushing the lower end of those ranges that we've seen this year. Bond yields have dropped across the board, across the curve. whether it's 2 years or 10 years. And in the US and Canada, we've seen those yields start to drop. So clearly, inflation concerns are abating. That hasn't been the talk for the last several months. We haven't been too worried about inflation. And so we've seen the US Fed start to cut rates again. Whether they need it or not, that's something that we should talk about in the outlook. And as usual, we've gone into Q3 with pretty pessimistic strategists looking into the earnings scene. This is with respect to S&P 500 earnings. You can see the lines here are strategists' expectations heading into Q1, Q2, and Q3 earnings seasons. They are always too pessimistic, and Q3 has been no exception. So strategists were expecting tariffs and other slow economic factors to start taking a bite into corporate earnings. But as we got through Q3 earnings season, which has just come to a close, that just hasn't been the case. And earnings were good, which is one of the reasons why markets remain relatively strong, even though expectations for earnings were to slow. And last thing to look back on is the resurrection of the meme. We did speak about this early in the year and the possibility for some market thematics to come to play. These are very interesting to see the inflows into thematic ETFs. Now, thematic ETFs are difficult in the investing space because really they're just built around a certain theme or a certain industry and nothing around the fundamentals of the companies that go into that index. So we can see, of course, big flows into AI-related themes, but also quantum computing, infrastructure, nuclear, and esports have been recipients of net investor inflows into those thematic ETFs. So it's an interesting dynamic for the market to be dealing with flows into non-fundamental reasons. But those are largely based on sentiment and not fundamentals. So it's a different kind of investing altogether. But that has been a theme through Q3, and we're seeing it extend into Q4 as we are today. So that's about it for our Q3 recap. Look forward to our outlook, which will be on the tape shortly and next in your video feed.